How do you trade in a trending market? Do you just draw a trend line, and if the market is trending, you enter the trade? Do you use a 200 period EMA and enter when the price crosses above or below it? The truth is, there are a lot of ways to enter trades in a trending market, but in this video I'm gonna show you one of the best methods out there, and that is by using a pullback strategy. Let's get into it. Now, you may be thinking, but what is a pullback? Well, put simply, a pullback is a short-term price movement in the opposite direction of the overall trend. We all know that trending markets don't move in a straight line. In an uptrend, for example, you'll see something like this: a series of higher highs followed by a series of higher lows. When the price moves from a higher high to a higher low, this is a pullback, and it's the optimum place to enter your trades. In a bearish trend, it's the opposite. Now, at this point in time, you may be thinking, but how do I identify a pullback in the first place? Well, the first method that we can use to identify pullbacks is by drawing a trend line. Now, as you can see here, each time the market did a pullback, it later reversed in the direction of the overall trend immediately after touching the trend line. So based off of this, you can say that each time the market creates a higher high or a lower high and comes back and touches the trend line, that becomes a pullback. The opposite is true, of course, for a bearish trend. But identifying pullbacks this way has one major problem, and you probably might have figured it out already. Trend lines are very subjective. I mean, how do you even draw a trend line? Do you draw from the bottom of the wick and extend it to the right, only touching the wicks? Do you push it a little higher or a little lower? What if the price breaks and closes below the trend line? Is that still considered a pullback? There are a lot of questions. To avoid them, we're going to use a trend filter indicator called market bias. This one by Professor X. Double-click on it to access the settings panel. On the Style tab, you're going to uncheck this first option and then click OK. Now, the way this indicator works to identify pullbacks is very simple. In a bullish trend, the normal trend color is bright green, like this one. Whenever the market does a pullback, this trend ribbon changes color from bright green to dark green, like it did right here. This signifies a pullback in a bullish trend. In a bearish trend, the normal trend color is bright red. During a pullback, the trend ribbon will change color from bright red to dark red, like it did right here. So now you know how to identify pullbacks, but how do you decide when to enter your trades? Well, for starters, you can use candlestick patterns, like an engulfing candle, for example. An engulfing candle is a candle of opposite direction relative to the previous candle and has a bigger body than the previous candle. Like right here, you can see that the market did a pullback. And we know this because the trend ribbon of the market bias indicator turned from bright green to dark green. After the pullback, the price created this engulfing candle and you could enter the trade right here. Now, as you can see, using engulfing candles can be great. But if you're like me and you hate the subjectivity that comes with looking at candlestick patterns, you might want to use an indicator called Williams percent range. This one by this guy. And then you're going to double click on it to access the settings panel. On the Style tab, you're going to change the upper band's value to -30 and the lower band's value to -70. And then you're going to change the upper band's color to red and change the display style to line. Then here you're going to change the lower band's color to green and change the display style to line. And then click OK. The Williams percent range is a momentum-based oscillator used to identify overbought and oversold conditions in the market. This yellow line is the percent range oscillator, and this blue line is simply a 13-period exponential moving average. We're going to be using it as a buy-sell entry signal alongside the market bias indicator, which will be used for pullback confirmations as well as trend identification. When the percent range oscillator, this yellow line, crosses above the moving average, this blue line, and the cross happens below the -70 level, that is a signal to buy. But when the yellow line crosses below the blue line and the cross happens above the -30 level, that is a signal to sell. So how do we trade using this strategy? Well, I'll tell you just after introducing the sponsor of this video, HenkoTrade. If you're looking for a broker with some of the lowest commissions and spreads in the market, then check out HenkoTrade. I use them on a daily basis. As you can see here, this is my trading history. I mainly scalp gold, and up here you can see that it's a live account. For those of you that love high leverage, HenkoTrade offers up to 500x leverage, which basically means that my $1,000 deposit could have the buying power of $500,000, which is really insane. And if that's not enough, they're also going to give you a 100% bonus for all your deposits up to $25,000. So if you deposit, say, $500, they're going to give you a bonus of $500, so you'll have $1,000 to trade with. To get access to the bonus, as well as all the other perks, sign up to HenkoTrade using the link in the description of this video. Now, back to the video. Now, to enter a long trade, these are the conditions. First, the trend ribbon of the market bias indicator should be colored bright green and the price should be trading above it. This indicates a bullish trend. Second, the price should do a pullback. If you can remember earlier, we said that a pullback is when the price comes back down and creates a higher low or a lower low and the trend ribbon changes color from bright green to dark green. So we're going to fast forward for a bit and see if that happens. Yes, this is a pullback. Lastly, we want the percent range oscillator, this yellow line, to cross above the 13-period moving average, this blue line, and the cross should happen below the -70 level. Also, at the time the crossover happens, the trend ribbon of the market bias indicator should still be colored dark green. This indicates that the market was oversold in an uptrend and the momentum is now shifting back to bullish. If the crossover happens after the trend ribbon has already changed color to bright green, that setup becomes invalid. All our entry conditions are met on this candle, so we're going to enter a long trade. The stop loss is going to go below the most recent swing low, and for the take profit, we're going to set it at 2.5 times the risk. We let the trade run and take profit. For short trades, we're just going to do the opposite. First, the trend ribbon of the market bias indicator should be colored bright red and the price should be trading below it. This indicates a bearish trend. Second, the price should do a pullback. Now, a pullback in a downtrend is when the market comes back up and creates a higher high or a lower high and the trend ribbon changes color from bright red to dark red. Let's see if that happens here. This is a pullback in a bearish trend. Lastly, we want the percent range oscillator, this yellow line, to cross below the 13-period moving average, this blue line, and the cross should happen above the -30 level. Also, at the time the crossover happens, the trend ribbon should still be colored dark red. This indicates that the market was overbought in a downtrend and the momentum is now shifting back to bearish. If the crossover happens after the trend ribbon has already changed color to bright red, that setup becomes invalid. All our entry conditions are met on this candle, so we're going to enter a short trade. The stop loss is going to go above the most recent swing high, and the take profit is going to be set at 2.5 times the risk. We let the trade run, and it hits take profit. Now, as you can see, this is a simple yet powerful pullback strategy that can be applied on any trading security. And to answer your questions, yes, the strategy can be applied on any time frame that you like to trade. If you're planning on using this strategy, remember to do extensive backtesting and forward testing and customize it to your liking so you can have as much confidence as possible when trading with it. That's been it for this video. Hope you found some value. If you did, hit the like button below and consider subscribing to stay tuned. Thanks for watching, and I'll see you guys next time.